Hello everyone, my name is Manolis Sfinarolakis, the founder and producer of Reality Crowd TV, and welcome to episode 30, Accredited Investors and Real Estate Crowdfunding Platforms. We have a wonderful show tonight with 4 great guests on our show. But before we actually get to introducing everybody, I'd like to just do a few ground rules just like we do on every single show. We have a Q&A application where if you're watching the show live, you will have the opportunity to ask our guests any questions that may come about the from the discussion. We also have a new application on Google Hangouts called the Showcase application. And if you're watching live through the Google Plus event, you see all the links of our guests on the sidebar. You see the link for to contact Reality Crowd TV. You see the CrowdBouncer direct link where you could click and get more information about CrowdBouncer.com. You also have the link for RealtyShares.com if you want to get more information and register as an investor on their platform. You also have our co-hosts of Inner10 Capital. You have their investment firm, and also our co-host with Invest ATX Capital. So this is a new feature, and if you'd like to see any of our guests, feel free to click on any of the links anytime throughout the show. Additionally, if you do want to ask those questions, you must follow the circle of Reality Crowd TV. And again, we always want to say thank you as well, viewers who are watching right now. Without you, we couldn't do what we do week in and week out. So with that said, I'd like to introduce our guests. And first, I'll introduce our first guest, Bob Carbone, the co-founder and CEO of CrowdBouncer. And Bob, thank you for joining us, and please introduce yourself.
Sure, yeah. My name is Bob Carbone. Like Manolis said, I'm the co-founder and CEO of CrowdBouncer. We run a software platform that uses validated data to solve compliance problems in the securities compliance industry. So my background is actually in law. I'm a securities attorney. Left to practice the law basically to build this software platform to make compliance pain points as frictionless and low cost as possible, to basically make the new securities crowdfunding activity that was legalized under the Jobs Act as frictionless and painless as possible. So like what our platform does is it tries to make securities compliance issues so easy to accomplish that somebody will be able to buy private equity, as simply as you would go on to Scottrade or E-Trade and buy, listed shares. So our big product right now is our accredited investor verification product, which is really a threefold product. We do accredited verification, accredited verification, identity verification, and anti-money laundering screening, which are 3 issues that are, both sensitive to the securities industry and are somewhat necessary in the new, for the new emerging crowdfunding ecosystem in the aftermath of the Jobs Act.
Great, Bob. Thank you so much for that. And what your service does is really it allows for equity crowdfunding to be in compliance with all the regulations. So without the service that you do, you may not be out front. You guys are on the back end making sure that everything that's done is 100% compliant, and that's probably one of the most important jobs that unfortunately no one sees. But tonight, people are going to get an inside look to know exactly what you do. So thank you, Bob, for joining us.
Thanks.
You're welcome. Yep. So our next guest is Nav Athwal, the co-founder and CEO of RealtyShares, which is a real estate crowdfunding platform. And Nav, thank you for joining us, and please introduce yourself as well.
Yeah, thanks, Manolis, for having me. As you've said, I'm the co-founder and CEO of RealtyShares, which is an accredited investor crowdfunding for real estate platform. We provide accredited investors located across the U.S. access to residential and commercial real estate investments, both as debt as well as equity, meaning an investor can either become a lender, earning interest income on a monthly basis, or an equity owner earning rental income and upside when the property is sold. We've been around for about 18 months. Prior to founding RealtyShares, I was also an attorney, real estate and land use attorney. We've been around for about 18 months. In that time, we've funded over 70 properties across 12 states. And we've done everything from single-family homes to retail centers, anchored by major tenants like Target and Safeway, office buildings, government lease buildings, apartment buildings in Austin and Dallas and Florida. So we've been very active. As a real estate and land use attorney, I represented large REITs and institutional clients on some of the largest projects in and around the country. And the idea of RealtyShares really came from those experiences. I saw big investors investing in these premier assets, earning great returns, but individuals, having difficulty with that same level of access. So the strategy and the motto of RealtyShares is really bringing real estate to a wider class of investors. Today that includes accredited investors. Maybe tomorrow it includes a wider class of retail investors. So that's what we do.
Excellent. Thank you so much. And I didn't know that RealtyShares has done that many properties. You guys are you guys are basically just putting your nose to the grindstone, doing a lot of work, and silently you've funded 70 plus properties in 12 states. I didn't know you guys were that large. So congratulations to you and your platform. That's great.
Yeah, we try to fly under the radar a little bit.
I hear you. So great, and so then our last two guests, we have a dynamic duo out of Austin, Texas. We have Bryan Hancock, the CEO of Inter10 Capital, and Bryan, please introduce yourself.
Yeah, thanks for having us. I'm Bryan Hancock here in Austin, Texas with Lamar. My business partner John couldn't make it today. He's in a different state, but we are an investment firm here in town. We've been very active in the crowdfunding space, primarily have focused on residential development projects in the Austin area, which have been very lucrative over the last 5 or so years. I've been an investor for about 11 years now, and been raising capital through a fund for about 5 of those years. And we recently started a new fund that's a single-purpose syndication fund called Inter10 Capital. So that's what we're doing right now, focused primarily on infill development projects in the Austin area. Right now we have 45 different infill projects going, and we've successfully crowdfunded 2 of those projects this year. So we do have a little bit of experience with crowdfunding from the promoter developer side, and we actually just started our first debt raise last week, which subscribed 20% in the first day. And ever since then, it's kind of been slow. So it's kind of interesting to see how things go when you crowdfund stuff. The day of the week matters, and a lot of different stuff matters. But that's a little bit about me. Lamar, did you want to introduce yourself?
Yeah, my name is Lamar Kennan. I'm an investor as well. My company is InvestorID Capital. We do infill development projects. We're just getting into that. We do a lot of short-term real estate investments. And our goal is to continue using crowdfunding for a majority of the deals that we do, especially our new development projects. And so I've been hanging out with Bryan and partnering up with those guys on some deals and participating in the crowdfunding that they're doing. So it's really interesting getting into the crowdfunding space.
Great. No, definitely. And you guys are really the sponsors of this real estate series. We teamed up with Lamar Cannon, InvestATX, and Bryan Hancock, Inter10 Capital, to really put on these real estate series, because what many people don't realize that currently in America, most people they really only know crowdfunding through the rewards and donation-based model, where you have your Kickstarters and your Indiegogos of the world. But silently, the government passed back in 2012. They passed a law called the 2012 Jobs Act. So instead of donation in exchange for a reward, this new piece of legislation is allowing for investment in exchange for a purchase in a share of a private company, or lending a company money in the form of debt and earning an interest rate on that debt. So the game is changing slowly. The government passed this law in 2012. It had three parts of the law that related to equity and debt crowdfunding. And as of today, only one of those sections, one of the 3 that was in that law, is fully implemented, which is known as Title II equity crowdfunding. And what that did for investments is it allows for the general solicitation of accredited investors. A little history lesson: the Securities and Exchange Commission, which is the government organization that is helping to implement these laws. Previously, if you were a startup company, or if you were a real estate developer and you wanted to raise money for your project, you couldn't go out and just broadcast that you had a property and you need $5 million for your property. You couldn't go out on Twitter and broadcast that. or else you would be in trouble with the government, because that's generally soliciting anyone for investment in your property. But as a result of this amazing new law called the 2012 Jobs Act, and many of our panelists will attest, there's some things that it's not perfect either, but because of this law, it's opening up a lot of new sources of capital for small businesses. So for our viewers out there, I really wanted to level set, because many of you only know of donation in exchange for a reward, but the focus of our show today is going to be equity and debt crowdfunding, because that is the new movement that is sweeping the nation. So I hope that clears it up for everybody. And with that said, I'd love to turn it over to Bryan Hancock, who will begin who has a lot of thoughtful questions, and he'll begin us off here. So Bryan, please take it away.
Well, since we've got a securities attorney online here, maybe you know, along with that level set, Bob, could you just kind of give our viewers a little bit of a level set on? Manolis made reference to the first of 3 of these pieces of the Jobs Act being implemented. Could you just give everybody maybe a quick overview of Titles 2 through 4, just so people get an understanding about where things are now and possibly where things may be heading, hopefully later this year or next year?
Sure. Yeah. You know, honestly, like 2 and 3, I know like the back of my hand. 4, Regulation A, I haven't spent too much time parsing through, but so Title 2 of the Jobs Act is basically the article of the Jobs Act that gave us Rule 506C of Regulation D. So try and break that down into digestible terms for people who aren't attorneys out there. As a baseline rule in the U.S., since the Great Depression, we haven't been able to, publicly advertise offerings of securities unless they were registered. They have to be registered with the SEC. The registration process with the SEC is really expensive. It's time-consuming. Nobody really wants to go through it. So nobody registers securities if they don't have to. We have something called Regulation D, which is an exemption from registration requirements. And Regulation D, since basically the 70s, is what the majority of people use, both investment funds and private companies, to raise capital privately in this country. We haven't been able to use general solicitation in conjunction with Regulation D up until the Jobs Act was actually implemented, until Title II of the Jobs Act was implemented actually effective as of September 23rd of last year. So now we have this, like I said, it's called Rule 506C of Regulation D, which allows us to publicly advertise on the internet, over the radio. You can make T-shirts with your offering of securities on it. It doesn't matter. You can use any channel of public communication you want to advertise your offering of securities, and you don't have to register them with the SEC. But with great power come responsibilities, of course. And the 2 big restrictions on it are: number 1, you can only have accredited investors in these offerings, which are basically investors that meet certain wealth metrics. And you have to take reasonable steps to verify that every person who actually invests in that offering is in fact an accredited investor. So you can't just have them represent to you that they're an accredited or something along those lines. You actually have to be looking at certain types of documentation that proves that they're an accredited investor. Title III of the Jobs Act is true crowdfunding. So there's some purists out there that don't actually believe that Title II is crowdfunding, because it's really restricted to only accredited investors. Like I said, people who meet certain wealth metrics, and they don't like when you use the term crowdfunding to refer to Reg D offerings that are publicly solicited. I'm not one of those purists, but that is kind of a prevailing thought among some people. Title III is intended to totally democratize the private placement process in this country, where not just accredited investors, not just people who are wealthy can participate in these offerings, but everybody can participate. So if you're a person that's, in any profession to some degree, you can invest in the next, would hopefully be the next Google, the next Facebook, companies of that ilk. Title III of the Jobs Act is not yet implemented. We have proposed rules. We've had proposed rules actually since October of last year. We're long overdue for actually implemented rules for Title III equity crowdfunding, or as it's actually referred to in legal parlance, it's Section 4A6. It's a little bit unclear when we are finally going to get legal rules for equity crowdfunding. We're waiting on the SEC for it, and there's a little bit of a cloud hanging over the SEC's rulemaking process due to the fact that there's some upwelling of people in Congress that want to pass Jobs Act 2.0. So now we're a bit concerned that the SEC is going to be gun shy about releasing any rules now or making any rules effective if they're just going to have to turn around and redo them because there's a new piece of legislation coming down the pipe. So we have Title II legal regulations, accredited investors, crowdfunding. We don't yet have true equity crowdfunding Title III of the Jobs Act, and we don't really know when it's going to happen.
Great, and actually, let me just jump in really quick, Brian, because I actually wanted to make sure that I clarify this, because whenever people hear Title II and they hear that you have to be an accredited investor, an individual who makes $200,000 a year or is worth $1 million in net worth, in order to invest in these offerings and these private companies trying to raise money. Yes, it restricts who can invest in these opportunities. But if you are the startup that needs to raise capital, you don't have to be wealthy. You don't have to be an accredited investor in order to bring your deal or your startup to one of these funding portals in order to get funded by the wealthy investors. So I always want to just clarify that, because no, you can't invest in the property, but if you have a deal that you want to bring to the table, you don't have to be an accredited investor. Anyone can bring deal flow to get funded to any of these portals, whether it's real estate, whether it's a small business funding portal, whatever it is, anyone can bring it today. You just can't invest in these opportunities. So I wanted to make sure that was clear, because I think a lot of people don't realize that. They hear, oh, it's only for the wealthy, forget about it, it's not for me. No, if you're an entrepreneur, it is for you, and it's for you in a big way. So I wanted to make sure that was kind of clear there. So just want to jump in there. So Brian, go right ahead.
Yeah, so I mean that's a great level set, Bob. Thanks for that. Nav, could you give everybody? I mean, we talked a little bit about the verification process and a little bit from promoter standpoint, but maybe you could add some color from a portal standpoint. What sort of decision-making process is gone through for a portal to decide whether they're going to operate under one exemption versus another? I know that there are some 506C portals out there right now, and there's also some 506B portals. So could you maybe walk everybody through a little bit of that decision-making process and what portal you're operating?
Sure, thanks, Brian. Bob, wonderful overview. I feel like it was Securities 101, like class I took in law school all over again. Yeah, so it's a really methodical decision. I mean, it's not a decision to be taken lightly by a portal, because your burden as a portal goes up tremendously depending on whether you choose 506B or 506C. Title III is not yet in play, so we're not dealing with that yet, but 506B versus 506C is. At RealtyShares, all of our offerings are exempt offerings under 506B, so we have not yet treaded on the side of 506C, although we intend on doing so in later this year or early next year. I think the biggest thing to consider if you're a portal and you're determining whether you want to choose one or the other is the burdens and the additional verification checks. So 506B allows for self-certification, and there is a cooling off period before an investor can actually invest in a live offering, but it allows the portal to pretty much have a questionnaire that's been approved by the SEC in various no action letters that have existed for over 5 to 10 years, and it's up to the investor to fill out that questionnaire, and you use that questionnaire and the responses the investor gives to basically determine, are they accredited or are they not accredited. So it's that simple, really. It's basically self-verification without any additional burdens or steps needed on the part of the crowdfunding platform. Now, 506C, as Bob alluded to, requires you to take reasonable steps to determine whether someone is or is not accredited. The safe harbor way to do that, the explicit way the SEC said would be appropriate, is tax returns or audited financial statements by an accountant. Obviously, when you're trying to encourage investments and you're allowing investors to participate with small investment sums, like we're doing at RealtyShares, the last thing you want to do is create additional burdens on the investor to have to go to their accountant or have to go get an audited financial statement that you then utilize to verify their status as accredited. So the reason why we've chosen to stay within 506B is really to make the experience for the investor easier. Now, over time, once investors get more comfortable with crowdfunding as a way to invest in real estate and in startups and other verticals, we can see, and through platforms like CrowdBouncer, it can become easier to do those verifications. But today, it's a pretty time-consuming and a pretty burdensome process. The other thing, and I'm sure Bob knows a lot more about this than I do, is at the time the SEC passed the Title II rules in September, they also passed proposed rules that have pretty severe implications if you screw up the process. One such consequence could be using the right to use 506 period. So basically, not even being able to function as a platform offering 506B and 506C exempt offerings. So I think the decision is really up to the portal. There are portals that have used 506C, but they have to go through additional steps. And when you're a small company trying to scale, any additional burden on the investor, on the user, is something that's going to make it harder to scale. So that's some of the things we've considered at RealtyShares, and the decision we've come up for the time being is use 506B. It has a much lighter process in terms of verifying accreditation, and once 506C has been a bit more utilized and a bit more vetted, then start using that as a way to publicly solicit some of our offerings.
Okay, yeah, Bob, can maybe you add some color? I mean, I think maybe some of the listeners and frankly myself are still a little hazy on what a general solicitation is. I mean, I've heard a lot of the portals operating under 506B. You know, what are we allowed? If I'm a portal operator, what am I allowed to do to go try and get more investors to my portal? At what point does something become a general solicitation for investors versus just advertising for the portal in general?
Well, I'm gonna have to give you a legal answer to that question. Or, you know, what Nav was talking about with respect to, you know, having a cooling off period, and, you know, having a questionnaire that investors answer to basically vet out that they are in fact accredited. That comes from two no action letters called the IPO Net and the Lamb Technologies no action letters. And what those two no action letters basically did was they set certain ground rules, you know, basically acknowledging, okay, we have the internet now, we have this interconnected system of people communicating with one another. There's no way that we can truly prevent securities transactions from leaking into, you know, the internet. How do we start to define what is and what isn't, you know, general solicitation? And they created a basic framework that says if something is behind a password wall, if all of the people who log on and pass through that password wall are, you know, represent that they're accredited investors, and if there's a 30-day cooling off period, we won't consider that general solicitation. So in other words, if you have this portal that is not publicly accessible due to the password and all the people are in fact accredited investors, and you're displaying communications to those people, those won't be considered general solicitation. Now, what I always tell our customers is if you're not doing anything consistent with that, be prepared that what you're doing could very well constitute general solicitation. So, you know, there's a lot of borderline practices that people have used for raising capital for years that the SEC doesn't have the time to enforce that is probably general solicitation. For example, it's, you know, pitch contests, you know, incubator, you know, basic incubator pitches where you're pitching to a group of investors you've never met. Anytime you're soliciting or offering or providing information about an investment opportunity to people that you don't know, and in a non-private forum, it could possibly constitute general solicitation. You know, the terminology has purposely been left pretty gray by the SEC to give the SEC a lot of power to evolve over time and, you know, be able to, you know, drop a thumb on things that they've identified as technology evolves that they frankly don't like and that they think is a risk to investors. So if you're running a 506 portal, I think it's important to make sure that all of the investment materials are behind a password wall, that you are actually collecting a representation from the investors that they're accredited before you're actually exposing the investment opportunities to them. If you're doing a 506C offering, if you're embracing general solicitation, like I, you know, kind of alluded to earlier, you can do whatever you want to advertise those offerings. You can be putting them on the side of the bus.
Yeah, so that's interesting. I wasn't aware of these no action letters, and it sounds like, Nav, you're probably relying on some of that with this 30-day cooling off period. It sounds like the 30-day cooling off period is kind of integral to all of that. And you made reference to folks not, you're not wanting to create friction, but doesn't this 30-day cooling off period create friction too? At what point is that more of a friction point than doing a 506C offering and going through the reasonableness checks? I mean, how do you know which is a higher barrier for people to jump over? Is that based on experience, or is that basically just something you guys have leveraged the experiences of others, or is that something you've actually run data on, or do you have any sort of thoughts on that?
It's a great question, Brian. I mean, I think, well, just first to explain the 30-day cooling off period, what it means is when you use 506B and you come onto a platform like RealtyShares, you verify you're accredited, before you can actually invest in any offerings, you have to wait 30 days. So you can be a member of that platform, an accredited investor member, but you can't actually participate in any of the offerings that are on the platform. So it's a great question. I mean, we really haven't tested it because we haven't done 506C yet. But the 30-day cooling off period, it's something that we've found investors don't love and don't, definitely have complaints about it, but it's easier for us to do than to verify everyone's income and net worth each time they go to invest. And the other thing to keep in mind is your income and net worth can change at any given time. So it's not just a one-time check. It's not just getting their W-2s and their audited financials once. I think, and tell me if I'm wrong, Bob, for the net worth, you have to do it every quarter, and for the income, you have to do it every year. So it's a repetitive process you're doing time and time again. Whereas the 30-day cooling off period is a one-time cooling off period. Once you've done that 30-day cooling off, you're part of that platform. And any sort of soliciting of offerings behind that firewall, behind that password-protected firewall, pursuant to the LAMP technologies and IPONet no action letters, is not general solicitation. And one other thing to keep in mind for platforms is the 30-day cooling off, the 30-day period is a safe harbor. The SEC didn't say whether 25 days would be sufficient or 20 days or 15 days. It just said 30 days would be enough. Lastly, I know there's been 2 recent no action letters from AngelList and Funders Club, 2 of the more active startup crowdfunding platforms. And one of the things I think that shouldn't be taken lightly is there's not even a single mention in those no action letters about this issue of general solicitation. In these no action letters of IPONet and LAMP technologies, they were passed in the late 90s. The internet's changed drastically since then. I mean, we went through a bubble, now we're going on a burst of the bubble, now we're back with crowdfunding being more popular than ever. So we don't know yet whether the SEC's changed their stance on the cooling off period and how general solicitation should and should not work, because most platforms have been really relying on 20 or 12, 13-year-old no action letters to basically function within this internet-based securities offering world. So I think the short answer is it's a one-time cooling off period versus a repeat check on someone's net worth and income.
Okay, well that makes sense. So Bob, I guess that kind of begs the question why the portal operators would want to go through these extra steps if they wanted to operate under 506C. I could see an operator or somebody that has their own white label implementation wanting to do that, but the portals that are set up for the purposes of listing other people's deals, what would incent them to want to go operate under 506C as opposed to relying on these 30-day cooling off periods from these previous no action letters?
Well, I guess the best analogy I can make is to who predominantly our customers are as a company. So like I said, our predominant product right now is accredited verification. And the majority of our customers aren't crowdfunding portals. They're investment banks, they're broker-dealers, they're various people, there's venture capital firms, and a wide practice in the securities marketplace and the capital marketplace is syndication. You have these networks of placement agents where somebody originates an offering, and then it goes over basically this network of people who all dip into their Rolodex and try and actually solicit the offering to their book of business. We have, I think, for the same reason that you would want to use, that investment banks and broker dealers do that now, you would want to do that potentially as the crowdfunding portals. So if you have the intent of outside agents that would potentially be driving the sales process for general solicitation. I think that, I'm sorry, if the crowdfunding portal plans on working with any sort of outside intermediaries or agents whose job is going to be to sell the securities, there's a high likelihood that could constitute general solicitation. And it's ultimately, I think that for offerings that are borderline to get funded or not, you want to be able to reach into as deep of a potential pool of investors as possible. And, being able to leverage a bigger network, increases the likelihood that you're going to actually close that offering. So I think for platforms that really want to, provide their clients, which are the issuers, with as many potential people to invest in that offering, they're going to want to use general solicitation. They're going to want to be able to publicly advertise that offering of securities. And, like I said, we don't just work with crowdfunding portals for that. We work with investment banks and broker-dealers that are basically saying, well, we've been doing this, now going to say this is general solicitation, so we better be prepared for it.
Okay.
Yeah, and actually, Brian, sorry, let me just jump in because, if I'm not in the funding portal business, nor do I have any plans to be, but I know that there's some statistics out there that state there's about 8.7 million people in America who qualify as accredited investors, and only about 400 to 500,000 of them regularly invest in private placements in these private companies. So I would say general solicitation is trying to get the other 8.2 million accredited investors to begin investing in private companies, because now they'll know about it easier. So I'd imagine if you were able to find a great marketing program that brought you in, 100,000 accredited investor registrations to your funding portal, I think you'd be willing to go through the compliance costs, because you probably just got close to multiple $1 billion worth of funding. So I mean, I'd imagine that if someone figures out how to effectively get those accredited investor registrations to their portals, they will be willing to take the added burden of Rule 506C, because now they're the most powerful portal in the world. At least that's.
If I can jump in on that point, Manolis, sure. I talk to a lot of investment advisors that say that they really want to deploy, for their really high net worth clients, where they're kind of acting on a discretionary basis to deploy that capital. They'd like to deploy somewhere between 3 and 5% of their clients' assets into an allocation of private equity. And the biggest thing that holds them back from doing that is deal flow. Is that they constantly say that they don't see the right deals to actually do that, because their local network of deal flow isn't good enough. I think there's definitely a special play there for general solicitation to help drive the right opportunities into the hands of people whose job it is to pick asset allocations for people who frankly should have some allocation in private equity.
Excellent.
Yeah, that kind of speaks to the role of the portals too. So now maybe you can jump in here. I mean, it seems I've talked to a lot of different portals, and everybody's kind of got a little bit different business model. But it seems to me like a lot of the portals are taking the approach that they want to wait and see how the reasonableness stuff checks out with 506C. They want to operate under 506B. When it kind of gets a little further down the primrose path, then they'll maybe go out and generally solicit for folks. But from a promoter standpoint, I really don't want the portal to just be functioning as a passive curator or lister of my deal. It would be very value added for me if they were actually out syndicating this in the broker-dealer network, or providing a lot of those more traditional broker-dealer type services. So, I mean, is that something you guys have thought through, and have you seen any of your, competitors offering similar services like that?
Well, I think Bob made a really important point. You use different tools when you need those tools. So one of the fortunate things we've had at RealtyShares is we're funding deals more quickly than we can find them. So the demand side of the marketplace isn't our bottleneck right now. We're funding deals in less than 24 hours. If we were taking weeks to fund deals, we would probably seriously consider 506C as a way to expand our investor pool. And then maybe at some point in the future, marketplaces have the chicken and the egg problem. We're going to have more deals and investors. that could be the right time for us to sort of endeavor under the 506c realm. So really, we're creatures of need, right? If we need capital, we do what we can to get capital. The other thing I think is important, and I think, Brian, you were sort of alluding to this, is what can you actually do under 506b? You can advertise offerings, that's clear, right? Advertising active offerings is a clear violation of general solicitation if you're using 506b. You can, but you can advertise the platform. You can tell people, look, we're RealtyShares. I'm doing it right now on Manolis's, Reality Crowd TV. I'm telling people, I'm telling the world, I'm telling listeners that I've never met before that RealtyShares is crowdfunding for real estate. That's enough, in my belief, at the moment, to get investors interested in that would be interested in investing in private real estate to at least take the step to sign up for RealtyShares. So to date, that's been a sufficient step for us. Telling people about RealtyShares has been enough for us to get the demand that we need today onto the platform. So I think that's part of it. In terms of your second question of using broker dealers, we are actually considering affiliating with a broker dealer. That's more of a compliance for how we take our fees and how we earn money and less about actually getting more investors on the platform. So broker dealer affiliation can help in a variety of ways, but for us it's more about compliance on how we operate, less about getting more investors. So yeah, I mean, other platforms are using 506c. Maybe it's something that they need to get more investors on the platform. Maybe they're trying to advertise their deals. Maybe sponsors are asking for it. But for us to date, using 506b has been sufficient to actively fund most, if not all, of the deals we've had come to the platform. We have a 98% success rate. Our average time to fund is like I said, less than 24 hours. So 506c hasn't been something that we've been too concerned about. But again, in the future, it can change, and that's when we probably seriously consider 506c as a way to get more active accredited investors onto the platform. And to Manolis, your point about 8.7 million, you said, accredited investors in the country, 500,000 actually actively investing. I think you're right. Being able to generally solicit could help activate some more of those accredited investors. But you also have to remember, almost everyone out there is trying to get the attention of these investors. There's a lot of noise out there. So I think it's less about the fact that you can actually solicit, more about how you solicit. I think you need to be intelligent about how you're soliciting investors. And just the mere fact that you're using 506c to put a billboard on a bus could be a huge waste of money and could do nothing but make your money burn a little bit quicker than it already is. So just some of the considerations we're thinking about.
True, and maybe this is a good time, Brian, if you would allow me to, speaking of the fact that you're trying to get the word out, I think this video that you have for RealtyShares would also give the audience an idea of kind of how this equity crowdfunding would work for real estate. I think it's a really good video, short, 1 minute 40 seconds. So I'm just going to play that for the audience so that they understand what RealtyShares does and they get a better idea of equity crowdfunding in general as it pertains to real estate. So we'll just quickly play this, and here we go.
Want to maintain control over your investment decisions by putting your money into real and tangible assets? Ever want to invest in real estate the same way you do a stock or bond? Then come share in real estate on RealtyShares.com, where we bring real estate to the crowd. Back in the day, you'd have to invest $50,000 or more with about a dozen investors to purchase a great real estate property. Unless you had a lot of cash you were willing to invest in a single asset, you couldn't participate. Now, through the use of crowdfunding, RealtyShares brings together hundreds of investors for a single investment instead of just a dozen, which makes it possible to participate in the same smart investment by investing much smaller amounts per investor. Here's how it works. Visit RealtyShares.com to browse a variety of real estate asset offerings. Pick the one you like the best and invest as much or as little as you'd like on that particular property. Then own a share in that property proportionate to how much you invested. You can monitor your properties on RealtyShares through regular updates and Q&A with the RealtyShares investment community, and spread the news of your real estate acquisitions on Facebook, Twitter, and LinkedIn, inviting your network to join in your real estate investment. You can get educated on real estate by visiting our university, RealtyU, and learn why investing in real estate is a smart alternative to the fluctuating stock market. Remember, real estate is real. It can't vanish overnight like a startup or a company. profit from your portfolio. And visit us at RealtyShares.com and buy something real.
Maybe we should ask Bob if that violated general solicitation.
Did that, Bob? Did that violate?
No, I didn't see any offering materials in there, so I think.
Cool. Well, good. Good. So that's good to know. All right. So yeah. So I mean, you know, I also like that video, Nav. I know you mentioned that you have some new material, but I especially like the fact that you focused on real investments, and then you flashed a picture of Enron. It kind of drove the point home a little bit.
Yeah, thanks, Manolis. Yeah, I mean, you know, I think the video is a little cheesy, but I think it does the job of educating, right? I mean, I think a lot of what crowdfunding is, in a lot of, you know, to a large extent, the success of crowdfunding depends on how we educate investors. You know, whether they're accredited or not. Just because you're accredited doesn't make you sophisticated, and I think that's one of the, you know, things that opponents of the Dodd-Frank changes to the definition of accredited investor are saying is it's not your wealth that makes you an intelligent investor, it's how sophisticated you are and how well you understand how financial investments work. But I think the video is just, you know, one example of education, telling investors what is out there in an intelligent way, being transparent about information, being a curator as a platform on what you allow on the platform are very important. You know, a couple bad apples or bad seeds can really devastate the entire industry. So I think it's very important for platforms, for sponsors, for intermediaries, for platforms like CrowdBouncer, sorry, to really take an active role in educating and telling investors about the various options of crowdfunding, 506B, 506C, Title III, like you're doing here today, but also being very transparent on the type of investments that are on the platform.
Absolutely, and you know, I'll turn it back over to Brian in a moment, but you know, you mentioned the good point that's currently being done. You know, this isn't even about crowdfunding per se, but the Dodd-Frank rule, as you mentioned, in Dodd-Frank, and I'm sure Brian might know more, or Bob, but they have to revisit the definition of an accredited investor every so often now, and so that's what they're doing right now. Is should they increase, you know, how much income these people have to make? Should they increase what their net worth should be, or can they go the opposite direction? Can they say, you know, technically an accredited investor now, you know, doesn't have to make this much money, but they should be a certain level of sophistication. So, Brian or Bob, would you like to weigh in on that in particular?
Sure. Yeah. So Dodd-Frank says that, you know, one of the Dodd-Frank provisions says that the SEC has to revisit the definition of an accredited investor every 4 years. It doesn't say it has to make any changes to it. It says it just has to actually consider revising the definition every 4 years. So the SEC is kind of going through those motions now. You know, ultimately, the SEC, the accredited investor definition, you know, was ushered in as part of Regulation D as a response to the Purina-Ralston Supreme Court decision, which said that the people who are investing in these types of securities are people who need to be able to fend for themselves. And the SEC defined fending for yourself in purely economic terms by saying, okay, well, these are people who can absorb a certain amount of loss, which I don't think is all that consistent with the actual Supreme Court decision. Naturally, you would think that the SEC would want to upwardly revise that definition over time just to keep, you know, pace with inflation. But I think that, you know, one of the things that we also have to keep in mind is that technology has improved. I mean, one of the beautiful things about crowdfunding is that you have this mob of people that could potentially, that are getting their eyes on a potential opportunity and have the ability to, you know, discover fraud before it actually has its, you know, the ability to take root. I think that I'm hoping that the SEC doesn't make any alterations to the definition of an accredited investor, because I think it could have a significant chilling effect on the amount of Reg D activity we have in this country. And I do think that, you know, like I said, the ability to, you know, be doing transactions online through crowdfunding is a transparency mechanism that helps, you know, is at the end of the day, I think, an anti-fraud measure. So despite the fact that obviously we should you have to take into account inflation, I think there's other countervailing forces that would militate that the SEC should just leave the definition alone.
If I could just add something really quickly, I think I couldn't agree more with Bob, but I also think these changes go against the intent of the Jobs Act, especially Title III. Title III wants to make it easier for retail investors to get involved with private placement, so it's not just restricted to the top 1%, whereas these Dodd-Frank changes could be devastating to that entire intent and make it more difficult.
Right, you have kind of an interesting issue of congressional intent there, because the SEC has an unprecedented workload right now in basically being handed Dodd-Frank, this overhaul of the financial markets here in the United States, and then the Jobs Act, which is creating new capital marketplaces. And Dodd-Frank wants to clamp down on certain things, and the Jobs Act wants to make things a little bit less restrictive. Ultimately, this the private capital formation had no role in the meltdown that occurred in 2007 and 2008.
Yeah.
Hopefully, when the SEC is trying to figure out how to kind of harmonize the congressional intent between Dodd-Frank saying we need to revisit the accredited investor definition, the Jobs Act saying we need to kind of democratize private capital formation in this country, they realize that the whole mandate in Dodd-Frank that we need to revisit the accredited investor definition is probably a little bit misplaced.
Yeah, couldn't agree more there.
So I wanted to take things a little different direction since Lamar hasn't had a lot of chance to chime in here. So this is all really complicated, Lamar. If you're trying to get started raising money for your projects, it seems like there's a lot to react to here. There's a lot of compliance issues. I mean, who do you feel like's really positioned to take advantage of this? Is it people with big social media networks? Is it people with familiarity with the old rules? Is it people that have gone and taken this certified crowdfunding professional thing? I mean, who is it that's teed up really right now to take advantage of this stuff?
I think in terms of with real estate and people that are actually doing deals, I feel like the investors that are doing deals that actually know what crowdfunding is, and they're like staying up on the rules and connecting with the portals and knowing a little bit more about the portals and the different directions that crowdfunding is going. I think that's really, really effective, and I think that's what's going to help investors be able to raise capital a little bit easier, because that's the reason that I'm so big into crowdfunding. I'm a little bit newer, or quite a bit newer, into real estate investing than Brian. And with crowdfunding, it's going to be a lot easier for me to raise money for projects than it is to actually go out and do it with the old rules. So it's not going to be too much easier, but it'll be a little bit easier to kind of get more investors that I've never met before. Of course, we still need to develop our social networks and different things like that. But I think it positions a lot of investors for how to have an easier time raising money. And that brings me to my question for both of you guys, Bob and Nav. Who do you guys feel like are best positioned in terms of real estate investors, are best positioned to take advantage of like the new crowdfunding rules and general solicitation? Is it just the people with big social networks, or what do you guys think?
I mean, Lamar, you bring up great points. The first thing I think you brought up is, the value proposition is not just for the investor. Yeah, investors are getting access to a new form of investments and it's a much more streamlined way to participate. But private capital seekers, sponsors, as we call them, we don't like using the word investor, otherwise it'll confuse people. But sponsors or borrowers looking for debt or equity capital, it's a huge value proposition for them. And so one of the things we do is we don't really rely on your social network or your knowledge of crowdfunding. Most of the sponsors that we work with know nothing about crowdfunding and are confused by the very term. It's our role as a platform to serve as that educator. So just like we educate investors about how investing in a crowdfunded asset works, we also educate our sponsors about how raising capital from the crowd works. I mean, most of our sponsors, I spend hours on the phone just explaining how it works. We have a very robust how it works section, both for sponsors and investors, to explain how it works. So I think the beauty of crowdfunding platforms like RealtyShares and AngelList and Funders Club is they take the headaches out of having to know all the intricacies of how crowdfunding works, as well as raising the capital. We're your outsourced capital formation engine. I mean, you bring us a good deal and you have a good track record, then we do the work. So I think that's important to keep in mind. I think in terms of who we work with versus who we don't work with, is we just have general parameters on the kind of deals we'll fund. We don't want to fund development deals because we think one of the beauties of crowdfunded real estate is the ability to earn yields immediately, earning a monthly income or a quarterly income, whereas money markets and bonds are barely paying anything, is one of the allures of crowdfunded real estate. Number two is we expect you to have a track record. We want to work with sponsors that know how to own and operate real estate assets so they can actually successfully operate them and earn returns for investors. So we don't really require you to know how crowdfunding works or have a robust social network. We just require you to be a quality real estate sponsor that has a good track record. That's what we look at. If that fits, then we'll help you with everything else. We'll help inform you on how crowdfunding works. We'll help raise the capital for you. And most of the sponsors we've worked with use us on numerous occasions. We work with sponsors to help them raise debt and equity capital on more than one occasion. We've helped one sponsor raise capital for 5 different investments because he had a great track record and we did all the work. And you know, the ease with which he raised capital and the ease with which he's able to report to investors through our technology makes him a firm believer that crowdfunding is a real alternative to hard money lending, to banks, as well as to private equity capital through friends and family. So I think that's important to keep in mind.
Yeah, I think that those are all important points. I think one of the myths or misunderstandings, sort of, I post on a lot of popular real estate forums, and everybody thinks that they, you know, there's this new crowdfunding thing out there, so they can just go throw their project up on the crowdfunding portal and the money's just going to flow in. And a lot of these folks don't have the necessary track record to pass through screening processes. But there's a lot of debate about what roles the portal should play in terms of curation and kind of how the different models work for the different portals. So I don't know if that's anything you have any thoughts on too, Nav, but that's sort of a common thing I see a lot is people wanting to participate. They've got access to the private, you know, the equity markets now, which they didn't have before through a lot of these new rules, but a lot of their constraint and the governor on everything is still a lot of the things you mentioned, the track record, you know, something to point to, something that designs out a lot of risk for the portal operator because, like you said, they don't want to be listing bad deals. So, I don't know if you have any thoughts.
Well, yeah, I mean, look, I think, Brian, everything you said is 100% correct. It's the reputation of the portal that's at stake if a deal goes south, right? If we invest in the wrong market or on the wrong part of the capital stack or with a sponsor that really doesn't have the track record and something goes wrong, it's going to be really hard for us to fund deals after that one deal goes wrong. And you know, I think I need to make clear that every crowdfunded investment has risk. There's no guaranteed returns. So no matter what the portal does, it's important to remember that anything can happen. A deal could go south, but as portals, our role is to minimize that risk. It's basically to de-risk to the extent we can these private real estate deals or startup deals, which tend to be a lot more riskier, so that our reputation doesn't suffer if something goes bad. So yeah, I mean, we play gatekeepers. It's sort of a selfish reason because we want to make sure our portal is still around 5 years from today and it's still able to provide access to private real estate capital for sponsors like Inter10 Capital, quality sponsors in markets that are attractive like Austin, but also so we can continue to be a real alternative investment source for accredited investors. And if Dodd-Frank doesn't screw things up, I think more and more investors will become, you know, believers of crowdfunding. And I think one of the reasons why so few accredited investors have been triggered is because it hasn't been this easy to access private real estate deals in the past. So I think we'll see those conversion numbers of AIs actually investing in these private syndications go up as crowdfunding continues to grow.
You know, Brian, actually, you raise a good point, actually, because, yeah, I mean, some portal's going to be able to come out there and, you know, and somehow essentially market themselves as, you know, we're a portal that is just providing the mechanism in which you can raise capital. We do not attest to the viability of these investments, kind of like how the donation and rewards-based model is going right now. I mean, I'm guessing because you're now dealing with the Securities and Exchange Commission and FINRA, that there's certain restrictions to someone just becoming a listing portal. And maybe they will be listing portals when the unaccredited investors come out. I see why it's a little bit curated now, but assuming that maybe there'll be a listing portal in the future, or maybe let's not assume that. How can an investor, or rather a developer without a track record, how can portals facilitate them building a track record? Could there be a matchmaking where you have a bird dog who brings the deal and he gets matched up with a mentor and they both do the deal together and suddenly they get a track record? I mean, are there, like, what innovative ways can potentially people get that track record to then qualify? Or really that's just not the whole portal's the responsibility of the portal? I guess I'll put that to you, Nav, please.
Yeah, Manolis, it's a great question. I think at this point we're so busy with just sifting through what is a good and what is a bad potential sponsor. We haven't given much thought to how to help sponsors become get a more robust track record. But I think you bring up a really good point, and this is something we always haven't been good at as a very small and lean startup, is getting to know it just as quickly as we get to yes. So, if you're a sponsor that applies for access to our platform and you want to raise capital and you're a fit, great. You're going to be able to use our platform. You have the right track record, and you're going to be able to, utilize, our credit investor database to fund it. But if you're a sponsor that's applied, we want to be able to tell you no just as quickly and why we're saying no. So even though we're not the ones holding your hand and helping you get that track record, you have information on why today your deal or your company is not a fit. So maybe you're doing development and that's not a fit for our platform. Maybe you are a brand new investor and that's why you're not a fit. I think it's the platform's role to be transparent with why that deal isn't a fit. But today, as much as we wish we could, we're not, we don't have any innovative ways to help increase that track record. But I think just if you're passionate about real estate, I was a real estate investor for a decade, and a broker and then an attorney. The best way to really do it is, at the beginning is just go out and do it. And I think there, friends and family capital, other forms of capital, and maybe there will be platforms in the future that allow you to just list a deal. But I think one important thing to also remember is even if we weren't curating, and this is a point Bob made, even if we weren't curating deals, the crowd is sophisticated enough to know when a deal looks good versus a deal looks bad, right? So if someone has never done a real estate deal before in the past, is trying to raise $1 million for a deal, it's doubtful that deal will get funded, even if we weren't curating it.
Would you agree with that, Bob?
Yeah, I would. I think it's feedback on eBay. It's the reason that you display how long someone has been a member of Yelp and things like that. You want validated data. You want to know the track record of somebody for not just the purposes of vetting out an investment decision. It's just how people operate. And I think that to that point, if you want to be continuously funding deals, you've got to be working with the absolute elite, deal flow, or the premier deal flow. I think that's one of the big challenges that a lot of platforms have, and I think it's also the reason that some are really thriving.
Excellent. Well, Brian and Lamar, we have about a minute left. We could certainly go over if there's any other questions. So, Brian, did you guys have anything else you wanted to cover tonight?
We could spend another 5 hours on this topic, I'm sure. I think it's interesting that, the role of the portals in the due diligence process. So, I mean, that's something I'd like to know more about from a RealtyShares standpoint. But I've seen a wide variance across the industry in terms of how well deals are vetted or before they're allowed to be presented. And a lot of that seems to be a function of how hungry the portal is for deals. Kind of like if you approached a small bank, 1 week they're not lending on development deals, and the next week they are because they have too much capital, some of it they need to put to work. So can you maybe speak to how that works? I mean, there's obviously a balancing act there. If you've got this voracious appetite of investors with no deal flow, does that impact your diligence on the operators? I mean, to me, in order to make the deals happen, if your business model is mostly a function of making a deal happen, which is really kind of like a broker model, then wouldn't you necessarily have to have some sort of bias towards making deals happen and moving the bar as to what's a quality operator based on how deal flow's matching up with investors at any given time?
It's a very intelligent point, Brian. I think it's a practice in self-restraint a little bit. You know, we get dozens and dozens of deals that come through our platform every week, and going through the ones that are a fit versus the ones that aren't a fit, and telling 90 to 95% of sponsors that they're not a fit is not easy by any means, especially when you have hungry investors that are looking for deal flow. But I think one big difference between us and brokers is we're there. Our reputation is always going to be at stake. So yes, it would be great to get a lot of deals funded and you know, be able to tell people we're funding X millions of dollars of deals every month. But when one of those deals goes south, that number is going to drop very quickly. So we're not just in it for the initial transaction. We want to make sure that the deal is successful. We've returned millions of dollars worth of investor capital already through successful deals, and that's part of the reason why we're able to fund deals so quickly, is because investors have come to trust our curation process, trust the kind of deals we're putting on. But to get to your wider question of how we're curating, I mean, the curation for our platform is really twofold. One is curating the actual sponsor, the borrower, and the second is curating the actual deal. So the sponsor and borrower curation is a background and credit check on the sponsor. We don't work with sponsors with any sort of bankruptcies, past foreclosures, or any sort of criminal conduct. So that allows us to really, you know, vet out a number of sponsors that may have that on their background. We also look at the track record. We typically require at least 5 years of experience in real estate with at least 5 to 10 previous deals completed, depending on the type of deals you're doing. Single-family homes typically are a higher barrier. Multifamily retail office tends to be a little lower because the deals tend to be larger. And then we really dive into the deal. We look at, where is the deal located? Is it in a market we want to participate in? Is the cash flow projections, the vacancy projections, the appreciation projections of the sponsor realistic? And if not, we sensitize it and determine if the resulting IRR and the resulting cash flow are still a fit for our investors. And then it's the deal type. You know, being in business for 15 months, we've really figured out what funds and what doesn't fund. So if we've put up a deal that doesn't fund, we're probably not going to put that deal up again, or a similar deal like that up again, because we realize the crowd doesn't want it. So the curation is both just determining, based on our years of experience in real estate, what is a good and bad deal, and what is a good and bad sponsor, but also what does the crowd really want? What are investors flocking towards? What markets do they like? So it's really something we're learning every day, but we do have processes and standards in place that allow us to quickly determine whether a deal is or is not a fit. And we'd rather have a period where there's no deals than have a deal that just aren't firm believers in as being a good deal for our investor base.
All right, right on. Manolis, I think we're over time, so I don't want to be respectful of everybody's time.
Sure. So very good. So we are a little bit over, but I just want to give everybody kind of like a last word. You know, feel free to share your websites and where people can find you. So so Bob Carbone from CrowdBouncer, any last words for the audience?
I don't think so, Manolis. It's been a pleasure to be here. If anybody watching is you know, interested in doing a 506c offering and wants to know more about accredited verification and how we can help, you can go to crowdbouncer.com or InvestorID.com, which is actually our consumer-facing web application for investors that just want to get verified without actually doing it at point of transaction.
Was that a general solicitation right there?
I don't think so.
Okay. Very good. And all right, Nav, next you can kind of you can give your last few words.
Yeah, no, this was great, Manolis. Thanks very much. I think platforms like yours are very important to the education of investors and sponsors. But yeah, our platform is RealtyShares. The URL is www.realtyshares.com. Although our platform and our investment offerings are limited to accredited investors, we are very active in our blog, and the blog is for educational purposes, so whether you're accredited or not, that is accessible. The URL there is realtyshares.com/blog, and we post about everything from crowdfunding laws to how real estate investing works. And we encourage guest posts, so Brian, Lamar, if you have great guest posts you'd like to share with our readers, we'd love to have you guys guest blog on our blog.
Awesome. Might have to take you up on that, Nav.
Great, Brian.
Perfect. And last but not least, Brian Hancock and Lamar Cannon, you guys can give you guys a last word.
All right, Manolis, I appreciate you having us out here. And then anyone that wants to connect with me, connect with me on LinkedIn. My name's Lamar Cannon. I'm most likely going to be the first one that pops up on LinkedIn, and also Twitter. The Lamar Cannon is my Twitter name.
Excellent. And Brian?
Yeah, and so I'm with Enter10 Capital. We're a real estate development firm and capital raising company here in town, a private equity company. So we have quite a few investors from all over the world, folks in Singapore, folks in Israel, a lot of investors in California. So if anybody's interested in development projects in Austin, it's a great market right now. Can't build stuff fast enough, and as soon as I get it built, I get it sold. So love to connect with you. If you're interested in investing, please reach out to us. You can fill out our questionnaire on enter10capital.com, and that's www.enter10capital.com. And we're in the process of setting up our own white label portal to be able to list deals on our own site as well, and that should be fully functional here in about the next probably 2 to 4 weeks.
Wonderful. They're very good gentlemen. Again, Brian and Lamar, you guys, I'm kind of afraid of losing my job because you guys interviewed so well. So thank you guys for coming on here. You guys did great. And once again, my guests, thank you very much. And most importantly, the viewers, thank you all for coming. Again, without you viewers, we can't put this show on and do what we do. So thank you all for watching. And just like I close every night, until next time, dream it, believe it, achieve it. Good night, everybody.
Thanks,